The purpose of this video is to discuss IFRS 16 disclosure requirements, specifically the treatment in the reconciliation of net investment in the finance lease when the lease year is not the same as the financial year. This is illustrated in example 13. And also the treatment of an unguaranteed residual value in the maturity analysis of net investment in finance lease as illustrated in example 14. In this example, our financial year end is 30 September. However, the lease was entered into on the 1st of July 2014, meaning the lease year ends on 30 June. That means that for every financial year end, we will have to accrue for 3 months of interest that have been earned but have not yet been received in the lease payment. The journal that we'll have to do will be to debit unearned finance income in the SFP and to credit finance income in profit or loss. Those 3 months interest have already been earned because the time has passed, and therefore those amounts can be released from unearned finance income to go to finance income in profit or loss. This is the amortization table from example 13. If we want to calculate the closing balance of the net investment in the lease as at 30 September 2014, our starting point will be the amount at initial recognition of 301,500. So that's also the starting point of the amortization table. And to that we add the 3 months of the first interest component of the first lease installment. The balance as at 30 September 2015 will now consist of the starting balance of 301,500 less the capital component of the first lease payment that has already been received. So that gives us then the outstanding balance of 255,857 as at 30 June 2015. However, we want the balance at 30 September, so we still then have to go and add the 3 months interest that has accrued up until 30 September. In our reconciliation of the net investment in the finance lease, these amounts that we have now calculated as the closing balances will be the closing balances in our reconciliation. For 20x14, we started with a 0 balance and then we entered into the lease and our initial recognition was 301,500. To that we added the 8589. So we can see that this reconciliation is exactly the calculation that we did to get to our closing balance. For 20x15, the 310,089 will now also be our starting point for our reconciliation. Now this balance, we must remember, consists of the initial recognition of 301,500 plus the 8589 3 months accrued interest. However, in 2015, our closing balance was calculated as starting with 301,500 less the capital component of the first lease payment 45643 plus the 3 months interest that we accrued for 7289. So that means that the 8589 that was included in the closing balance in 20x14 should not be in our calculation for 20x15, and that is the reason why we have to now deduct it. The amortization table for example 14 is exactly the same as for example 13. The only difference is that the 15,000 is now an unguaranteed residual value. In example 13, it was a residual value guarantee. In our maturity analysis of the net investment in the finance lease, we start off with our undiscounted lease payments. So that's the cold hard cash that we are going to receive in future. However, we reconcile this to our net investment in the finance lease as we've previously calculated it. So the problem is that we're starting off with the gross amounts and we're ending off with the net amounts. Therefore, we have to now adjust for, firstly, the unearned finance income on these lease payments only. Remember that in our amortization table, we included all the interest in our amortization table was for the lease payments as well as for the unguaranteed residual value. So here we adjust only for the unearned finance income on the lease payments. So that will be our Calc A that we will have to do. The next adjustment that we have to make is for the unguaranteed residual value, and that will be our Calc B. To calculate our amortization table, we use this calculation of the interest rate implicit in the lease. And here we included the lease payments as well as the unguaranteed residual value. Now we have to calculate the unearned finance income on the lease payments only, which means our future value in this calculation will be zero. The calculation stays exactly the same otherwise, but the future value is zero. And also because 1 year of the lease is already passed, we will now use N4 because we've got 1, 2, 3, 4 years of the lease remaining. So this calculation therefore gives us the unearned finance income of the lease payments only for the remaining 1, 2, 3, 4 years of the lease. The problem that we now have is that gives us the amount as at 30 June 2015, and our financial year is 30 September. So we have to adjust for the 3 months where the interest has already been earned. Now note that this amount is going to be different from the amount that we calculated using the amortization table. And the reason for that is because the amortization table included the unguaranteed residual value, whereas the calculation that we are now doing, just only looking at the lease payments, will have a future value of 0. Next, we have to calculate the discounted unguaranteed residual value. So what we are actually doing is we are calculating the present value of the unguaranteed residual value as at year end. So we know that the unguaranteed residual value is 15,000. However, that is the value that it's going to be in 1, 2, 3, 4 years' time, actually 3 and a bit years' time. So what we now do to calculate that present value is we use the same calculation that we did for the interest rate implicit in the lease. However, now we only have the unguaranteed residual value. We do not have a payment amount in this calculation. So we're calculating what 15,000 Rand in 4 years' time will be worth today on 30 June X15, and that gives me an amount of 9741. But the 9741 is the present value on 30 June X15. So from 30 June X15 to the end of the lease term, the unguaranteed residual value is going to grow from 9741 to 15,000. But that means that for these 3 months up until the end of the financial year, the unguaranteed residual value has also increased in value, or the amount has increased, and the value that it has increased with will be 278. Okay, so the 9741 is the value on 30 June 2015, but then it increases with another 278 to give us a present value at the financial year end of 10,019.